Well, you're not alone. Many Americans are looking for ways to tap into the tremendous amount of equity they have in their homes. But then we look back and say, well, wait a minute, I have a mortgage right now with a 2, 3, or 4%. Even though I have a bunch of equity, I don't want to touch that. What we're seeing right now in the marketplace is that due to inflation, and even though it's starting to wane now, the effects have been Americans have largely depleted their savings, have run up credit card debt, and have been stuck, unable to restructure debt and consolidate debt or even get cash out to create an emergency reserve, to do some home improvements. All that sort of been put on hold. And the normal channel, or one of the channels, has always been, I can do a cash out refinance. But with rates being where they're at, that's off the table. But there is a solution, and that's a home equity line of credit or a home equity loan. I'm going to give you the short breakdown on each of those. I offer them, and they could be a very good option for you if you need to tap into some equity. So first, a home equity line of credit. It's basically a credit card against your house. In Texas, you can go up to 80% of the combined loan to value. In other states, you can go up to 95%, but in Texas, we're capped at 80%. And what combined loan to value means is you take the value of the house, you can go up to 80% of that. So you take 80% of the appraised value or the estimated appraised value. I'm not going to go into the details here on what that means, but there's automatic valuation models that can do a valuation estimate without an appraisal. You take 80% of that, minus out or subtract your current first mortgage, and what you have left that's what you have available for a home equity line of credit. The advantage is you're allowed to do 10 years of withdrawals. The normal equity line of credit is a 10-year withdrawal period. So that means for the next 10 years, you withdraw money and pay it back, withdraw money and pay it back. So it has tremendous flexibility, and you only need to use the money from the line as needed, on an as needed basis. So let's say you did a $100,000 line of credit and you only needed 25 now, you'd still have that other 75 available all the way for a full 10 years, just in case there was an emergency or an opportunity and you needed some cash to take advantage of it. The other benefit is the payment's low. It's an interest-only payment. The disadvantage, but it's also sort of an advantage, one disadvantage is that it's tied to prime rate, and prime rate is directly tied to the Fed funds rate. So the home equity lines of credit can go up based on prime rate, but they can also come down. And the Federal Reserve is just about done raising interest rates. So home equity lines of credit right now are anywhere from 10 to 13%, depending on your credit score. But with the interest-only payment option, it creates the ability to have flexibility, get some cash, and have a low payment on that cash, which is sort of cool. The other option is a home equity loan. Those are considered closed-end. So a home equity line of credit is open-end, meaning you can buy it, use it, pay it back, use it, pay it back. A home equity loan is a closed-end second, meaning it's a fixed term. So you would just say, I'm going to take out $50,000 to consolidate credit cards and get some cash out to do whatever you want to do with the cash. And then whatever that is, that could be put on a 5, 10, 15, 20, 25, or 30-year term. One thing I can tell you right now, even though the interest rates on those are higher than it would be for a mortgage. Mortgage rates, as of making this video, the average rate in the United States was like 7.3% roughly. So yes, you might be paying 10 to 12%, but keep in mind, your credit cards right now are at probably, if you really look at them, they're probably between 27 and 30%. And yeah, I said that right. That's where credit cards end up. And even unless you have one of the, like a fixed, a zero interest rate teaser for 12 months, once you're past that period and you stop paying attention, those rates are 27 to 30%. And for many of you, you might have student loans still. You might have student loans that you helped your kiddos out with. They're still on your books. All that stuff can be taken, put it into a home equity loan on an amortized schedule, and you can pay it back 5, 10, 15 years. I've had a lot of clients who are able to take their credit cards and student loans, put them into a home equity loan with the same payment they're making now, except that the way it was before, the student loan was deferred and the credit cards were just making a payment, but the balance weren't going anywhere. Whereas putting it on the right program, sometimes you can either actually lower the payment or even keep the same payment, but you're actually paying it off. So those are a couple great uses for these products. Like I said, I do them. I'm an expert at them. Reach out if you would like to learn more. I'm happy to assist you with it. So thanks so much and have a great weekend. Are you looking for some money? Well, you're not alone. Many Americans are looking for ways to tap into the tremendous amount of equity they have in their homes. But then we look back and say, well, wait a minute, I have a mortgage right now with a 2, 3, or 4%. Even though I have a bunch of equity, I don't want to touch that.